So today we're going to be looking at a new ETF launched by eInvest called ASX DHOF. This is the Daintree Hybrid Opportunities Fund. Now this ETF invests in global hybrids, which pretty much means that this is a fixed income ETF. You'll be getting regular income from this fund as opposed to growth. Now, a few months ago, we also had a look at some other eInvest ETFs that are out there, so go check it out, link in description if you're interested. If you guys are new here, my name is Faizy. This channel is about finance and investing. Before we begin, as usual, this video is not financial advice. This is not a buy or sell recommendation. As you guys know, let's just jump into it. So pretty much the objective of this fund is to give you guys a steady stream of income over the medium term, and this is going to be a very diversified portfolio which invests in Aussie and global hybrid securities. Now, they of course do want to beat the RBA cash benchmark and more, which we'll have a look at in much more detail. So with this paragraph, let's actually just dissect what they actually meant, starting off with the medium term. Now, medium term basically means around a time horizon of 3 to 5 years, and that is usually considered medium. When it comes to, short-term securities, short-term is pretty much, less than 3 years, I would say. And when it comes to long-term, that's somewhere around, say, 7 years or more, maybe even between 5 to 7 years, but generally 7 years or more is considered long-term. So when it comes to this ETF, this is a medium-term ETF, meaning that if you do buy this ETF, it is recommended that you do hold for around 3 to 5 years because there will be some volatility in this ETF. So to actually make sure that you don't lose any underlying capital, it is recommended that you do hold it for between that 3 to 5 year period. Now you might be asking, what exactly is a hybrid security? Now, pretty much a hybrid security is a mixture of debt and equity. So for example, a company issues a hybrid security and you as the investor, you buy that security, and now what that means is that that company has to give you those regular payments. So in a way, it's kind of like a bond, but the company actually has an option to convert that hybrid security into the company's shares instead of actually giving you those repayments. So it's debt in a sense that the company is giving you those regular payments because they owe you that money because you own the hybrid security, but it is equity in the same sense because that company can convert that security into the company's underlying shares. So as an example, if that company is facing some sort of an issue with their financials and all of a sudden they can't actually, make those payments to you, what that company may do is they may convert that hybrid security into the company's stock, and they no longer have to actually, make those repayments to you. And you as the investor, you are now going to own shares in that company. Now, of course, if this company is facing some sort of an issue, obviously the share price is going to decrease. So in this specific scenario, your money is going to be worth less than what you put in. Obviously, the shares are going to drop, so you are going to have a lesser value. So why do companies issue hybrids in the first place? To pretty much get the best of both worlds. Like when you look at companies in general, they generally have, two ways of actually raising money. Firstly is debt. Secondly is equity. The company can borrow money, which means that they will have more debt, or the company can sell shares to the public, which is another way of obviously raising money. So these are the two kind of levers that companies have. And these hybrid securities basically allow the company to do a mix of both, kind of. Now, these are very risky and complex instruments to begin with. I don't really understand them fully. I only understand the overall gist of it. So this ETF is of course there to make sure that you can get an overall exposure to a range of hybrids, not just one, to kind of diversify the risk that is out there. Now on this channel, we don't normally look at ETFs like this at all. I think this is the first kind of hybrid ETF that we're looking at, or first hybrid video in general, but I do think it's pretty interesting for you guys to just learn about if you're interested. Now at the moment, there is a launch promotion going on as well. Pretty much if you invest before 31st of December, you will get the first half of 2022 fee free, which is very good if you actually like this sort of space. So yeah, there you go. But speaking of fees, how do the fees look like? Let's have a look. So as you can see, the management fees are 0.65% plus a 0.1% admin fee per annum, inclusive of GST and RITC, whatever that means, but no performance fees are there. Now, that is pretty expensive. Let's be very honest here, right? It's a pretty expensive ETF. We don't really see these sorts of fees with other ETFs that are out there. With even thematic ETFs are quite cheaper than this. It might seem a bit shocking, and these fees turn out to be around $75 per $10,000 invested. So if that's the case at the moment. Usually this sort of sector has lots of performance fees as well. So in the absence of a performance fee, they've just put a decent kind of management fee there. Now, obviously this goes without saying, fixed income investing is of course not for every single person out there. I thought it would just be a very kind of interesting topic to have a look at. Now, looking at the benefit of this ETF and fixed income ETFs in general by eInvest, we can see there's three options out there in terms of different risk levels and whatnot. These types of securities are classified as defensive securities because they're fixed income and they're quite diversified as well. Obviously, they're exchange traded, which is very easy to buy using a normal broker. And then lastly, these do give regular income. Some of these ETFs give monthly incomes, but DHOF actually gives quarterly income. Now, just on that first point that we spoke about, as you guys can see based on this little table right here or graph, this is a risk and return graph. Now, at the very start, we've got cash. Cash pretty much has almost no risk. It is basically cash. So of course, the return is going to be very little, right? As we can see, the interest rates are very little at the moment, less than 1%. So therefore, the risk is low, the return is going to be low as well. Looking at the very further end, you've got alternatives with very high risk, very high return. And then before that, you've got equity, so pretty much shares. You've got international shares, Aussie shares, and these are classified as being risky, but of course the return potential is there too. But then somewhere in the middle, you've got EMAX, which is a different ETF by Invest, and then you've got /DHOF, right? DHOF is the ETF that we're looking at. So this kind of offers a balanced, risk to return sort of ratio in that middle section. Looking at some of the other points for this ETF, it does have daily liquidity, which means that you can, buy and sell this ETF very easily. And they're just basically comparing it to a term deposit, where a term deposit is much more locked in. Once you put your money in there, you can't really take it out unless it's for hardship reasons and whatnot. So this ETF has much more liquidity in terms of, comparing it to a term deposit. And that is just an advantage of ETFs in general. The target return is between 3.5 to 4.5% above the RBA cash rate after fees, and they will be giving quarterly distributions as I spoke about earlier. So as you guys know, 3.5 to 4.5 is much lower than the stock market, which usually returns between 6 to 12% per year on average. But of course, just keep in mind that, as we said before, this is a defensive instrument. It is a fixed income instrument. It's not meant to be used for, getting those high returns. This is mostly to, balance out your portfolio, or for people that, can't handle too much risk. It is mostly used for, those sorts of purposes. So as we know, since the risk is lower, the return is going to be subsequently lower as well. Looking at the asset mix, we can see that it is bank hybrid securities with up to 50% offshore bank hybrids. Now, hybrids are usually issued by banks in general, so a lot of the portfolio is going to be, stuff issued by banks. And if you don't really like the banking sector in general, you don't like to help them out, and you think it's very unethical, this may not be, the best thing for you. Looking at the credit rating of these hybrids, we can see that it is BBBs/BBB minus. Basically, what this means is that this rating is classified as being investment grade securities, which essentially means that these are decent quality, these are medium credit quality, which means that the organizations that are, issuing these sorts of securities, we can be fairly confident that they will continue to keep on paying you those coupon payments, those quarterly payments. Whereas anything below this credit rating, it starts to be, fairly risky, with ratings like Bs, double Bs, triple Cs. These are lower quality assets, and there is a lesser chance that they will be able to, keep on making those repayments. It is much more risky. If a bond has been given, a rating of triple C, that is pretty much classified as a junk bond, which means that it's not really that valuable, and those companies can't really, keep on paying you that debt. Now, this sort of ETF is definitely not for me. I prefer to have 100% of my portfolio in stocks and ETFs with 0% allocation towards bonds and hybrids and fixed incomes. I just don't like to invest in, those fixed income solutions. Now, I'm quite young, so I don't really mind taking on the additional risk with having, 100% of my portfolio in stocks. But if someone is quite older or whatnot, or if they're very risk averse, this may be something to actually consider, along with some other factors as well. Of course, this is not financial advice. I'm not telling you to buy this ETF if you are very risk averse. Always make sure to speak to your financial advisor, speak to the professionals don't take advice from this video. Now, eInvest also has an actively managed ETF called IMPQ. This ETF is trying to pretty much beat the ASX Small Caps Index, and this ETF actually was one of the top performing ETFs of 2020. So check this video out right here. This video goes through IMPQ and some other ETFs by eInvest as well. And guys, thank you so much for watching once again. Please like and subscribe, and I'll see you in the next one. Bye now. Now, eInvest actually has a few